Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here with us today. We've got a lot of things to talk about, and we're going to be talking today about home sales. Home sales, some changes there we're going to talk about. Durable goods, that came out. We always watch the economy, how the economy is going. Durable goods is a very important factor. And pay decline. This is something we've not seen in years, so we're starting to see signs of pay declining.
Yeah, I'm going to say before we get into it, that's good for inflation. But as always, hey, you want to join the show, you got a stock you're looking at buying, selling, or holding. Again, I say stock. We call them equities, small pieces of large companies. But join the show here. Phone number is 833-288-0973. Again, that's 833-288-0973.
And before we get into it, yesterday they had the Jackson Hole meeting with Chairman Powell, and went okay. I thought he was going to be more negative, but he seemed to be more neutral, what I kind of interpreted it as.
Yeah, they keep saying they have work to do.
Right.
And inflation's still above their target, so in theory, yeah, there's still work to do. But I guess now there's still like a 50-50 chance that they increase rates one more time in November, and I feel like a broken record, but it's just meeting after meeting. It's like, I don't think they need to raise rates, and then they go ahead and raise rates, and it's just, at some point we're going to be right.
Right.
It's just,
well, and what month they paused? It was
it was the most recent one, I believe.
Right.
Yeah, and then they paused actually during the banking issues as well.
Yeah, that's what
that was the one. Yeah. And this is one thing we tell people too is when you try and look at, I'm going to say the macroeconomic, and you try and base your investment decisions off what you think the Fed is going to do. It's the silliest thing you can do because it's you could be wrong on what you think's going to happen, and then you could be wrong about how the stock market's going to react to what actually happened at the meeting. It's crazy, and that's why it's so important to just ignore this outside noise and focus on the businesses. Because if you're trying to play macroeconomics, it doesn't work.
And Chase, when people come in for a presentation to see if they want to use us to manage your money, we show them this one slide that shows that if you miss just the 10 best days over the last 15 years, your return is cut in half.
Yeah.
And that's why people don't do well in investing. And we know we've had bad days. We know it. But you don't know when they're going to happen. And when you think it happened, it doesn't. And when it does happen, you didn't think about it. Just don't do that. That's why we do what we do, is buying these businesses at great prices. And that's why I do the radio show, the newsletter, everything else we do is to try to help people out. But it's just you cannot try to predict what they're going to do. And that's why when we're looking at buying a business, we actually say, okay, should we wait for the earnings to come out? Should we not wait for the earnings to come out? Or should we wait for this to happen? Should we wait for the strike to happen? Well, if it doesn't happen, you've got to look at the business and say, look, I'm holding this for at least 3 to 5 years. Could be wrong for some time period, maybe 6 months, whatever, because the strike did happen. But what about 3 to 5 years down the road? You're going to miss more than you're going to hit right by trying to guess.
Yeah, that's why the philosophy we have is you're buying businesses, and there's going to be difficult time periods. I was going to say a lot of people are in business, and a lot of our listeners are business owners. And as a small business owner, or even if you're not a small business owner, you work at a company, that there's going to be difficult time periods. Yeah. That every business is going to go through a slowdown. Every business is going to hit some difficult period in the economy, and you just have to be realistic with yourself. Is it going to stay in that doldrum and that slowdown forever? No. And that's why you have to look through the noise and look through the longer term to make sure you have sound companies.
Well, let's move on to home sales, because existing home sales fell 2.2% in the month of July from June. Compared to 2022, sales were down 16.6%, and homes sold at the slowest July pace since 2010. Demand has definitely been hit by rising interest rates, and on Monday, the average interest rate on a 30-year mortgage rose to 7.48%. This was the highest level since November 2000. It will be interesting to see how home sales are impacted in the reports over the next couple of months. The existing home sales are based on closings, which means these contracts are for the current report were likely signed in May and June.
When the rate was lower than 7.5%. It's crazy to see that keep climbing there. But the supply of homes has also been a heavyweight on the sales levels, as there were just 1.11 million homes for sale at the end of July. This is down 14.6% compared to last July and is the lowest level since 1999. Now, looking compared to pre-COVID levels, there are about half as many homes available for sale. While the tight inventory has depressed the sales rate, it has also kept prices elevated, and there was actually a 1.9% increase in the median price of a home compared to last July.
That just flies in the wrong direction. I mean, prices are up. People can't afford them. That has to change. I mean, supply-demand forces will eventually come in. I hope they don't come in too large.
But the thing you have to realize is it's almost like a false number. And I'm going to go kind of way off topic here almost to try and make the same point. There's the Vietnamese EV company VinFast, and they've only released something like 1% of the shares outstanding.
Right.
Well, their stock went up like 100% in a day, and then it fell like 20%. And they now have a market cap, I believe, like $100 billion, which is larger than, Ford, GM, all the big players. But the reason is because the supply of the shares is so small. If they were to all of a sudden release, let's say, 60% of the shares to actually trade on the market, you wouldn't have those wild swings.
So what you're saying is that if rates came back down, the number of homes being sold would be larger, so therefore the sample would be better and probably be down. But because there's only a few homes being sold, you're getting this increase of 1.9%, which is only based on a few homes.
Because, as you said, the problem's affordability, and people just can't afford homes at these levels. But the thing is, the supply is so small, so those people that are still buying homes, those are the ones that can afford it, so they're the ones buying them, but all of a sudden you put more homes out for sale, the affordability really kicks in because nobody can afford it.
Right.
So that is, I think, the issue. And I know there's people that say, well, if interest rates fall, demand is there, so home prices are going to skyrocket. But my concern on the other end of that is, well, if interest rates fall, are more people going to say, okay, now I can actually get out of my mortgage and buy something else?
Right.
So then would the supply of homes increase? And as you said, you actually get a real sample of what the true demand and supply is of the housing market, because it's just crazy.
Yeah. And you wonder about the home builders. I mean, the home builders have done pretty well over the past, few years, but eventually that's going to change. I haven't looked at one. We sold ours a while ago, but I haven't looked at a home builder lately, but I would imagine that their valuations have to be kind of on the high side. Maybe not.
Yeah, or, earnings expectations could be quite elevated, because sometimes analysts believe that it's just going to keep lasting like this. And this is the perfect scenario for home builders. It's like, oh yeah, because they're a smaller part of the market, so pretty much everything they're building is selling, and they get the benefit of the higher prices, and they can also buy down rates for people that get into their homes, so they can kind of reduce some of that problem with the higher interest rates. It is a fantastic environment for these home builders, which I think over the next 3 to 5 years, it won't look like this.
I do have to say, to keep the price of home up that they're selling, they do have to give away more incentives. Oh, we'll give you free landscaping. Oh, we'll give you free drapes, or whatever the incentive is. So it's costing them more to get the same price or raise that price. So it's going to come back to hurt them a little bit, I think, down the road. So we'll see. So let's talk about the durable goods orders, because the headline number for durable goods orders may worry some and give them reason to question the strength of the economy. But as always, you have to look deeper into those numbers. The headline showed orders fell 5.2% in the month of July, but much of this decline came from Boeing. Orders for commercial planes can be extremely volatile. In the month of July, they soared 71%.
Yeah, and actually that was in the month of June they increased 71%. And then in July they fell 44%.
Did I missay that?
Well, you said in July they increased 71%. So In June, they increased 71%.
How did I do that? Okay.
You know, it's okay. So just to give people the numbers one more time. June, the commercial planes orders were up 71%, and then July they were down 44%. So again, just huge volatility in those numbers. And if we look at actually excluding the volatile transportation sector, which does include automobiles and planes, well, that actually increased 0.5% in the month. And excluding volatility created by Boeing, durable goods orders have now increased 3 months in a row. With all the volatility from COVID, the wild ups and the downs that we've seen in manufacturing and different areas of the economy, I do believe that the manufacturing sector and the overall goods economy can continue to strengthen from a challenge level over the last year.
Yeah, so I mean, it's just something that you got to look at the numbers and understand what's going on, because if you react to the number, the headline number, you could make poor decisions. And we keep continuing to say we're not in a boom economy, but we're not in a bust economy either. We're in an economy that's kind of ticking along at a slow pace, but ticking along.
Yeah, and what you have to understand is, the service economy has really kept up the broader economy, but the goods economy has really struggled. Well, I just don't see the goods economy really falling much further. So even if that flatlines and services comes down just a little bit, we can still have growth in the economy, because the goods economy has already been, I'm going to say, crushed.
Right.
Because we've talked about this before, but you have to understand the durable goods, everybody was buying these back in 2020, 2021, because they couldn't go anywhere and they had all this extra cash. It's like, well, I can't go on vacation, so I don't know, I guess I could buy a new refrigerator and get it delivered to me. Yeah, I guess I can get a new laptop, get it delivered to me. I don't need to leave the house. Right. So all these durable goods were purchased in 2020, 2021. And what should be happening here is, as that huge decline we've seen over the last couple of years kind of flattens, now going forward, you can start to build up again in that durable economy. And those durable goods will start to kind of fade. And all of a sudden they're 3, 4, 5 years old. It's like, gosh, I need to replace that. And then you have a more normalized economy. COVID just really created a very strange situation where you had these wild peaks and valleys. And I think we just need a little bit of normalization to get back to really being able to understand, and see good analysis there.
Well, I mean, COVID actually created, it pulled demand forward, is what it did, because normally you wouldn't buy this stuff, but since you were staying at home, you changed your purchasing thing. And that's why during COVID, you saw travel decline dramatically. Now we're seeing the opposite, to where you're seeing people traveling, spending money on hotels, travel, and less on, home furnishings and everything else. So that's why you got to understand how things are going on. And because travel is way up, still up. I don't know how much longer that's going to last, but it's still, people still want to get out and travel.
Yeah, I know I'm actually going to Europe later this year, and I just swear, on social media, everybody has gone to Europe this year, like that.
I'm leaving on tomorrow.
Yeah, I know. It's just I keep seeing, and it just seems like a popular thing to do right now. Which
travel.
I know Europe has been hit kind of hard as well, obviously, and hopefully is bolstering their economy a little bit.
It should. I mean, because you go over there and you spend money, you eat out and everything, so it should help their economy. That's why I always say the United States does really still control the world, because what is the saying? If we catch a cold, the world gets pneumonia, I think is what the saying is, because we do spend a lot of money in it, and imports, which are changing. We'll talk more about that another day, but I mean, we still control the world economy to some degree. All right. Let me get the phone numbers ahead of time here too. So if you want to call and get that unbiased, no strings attached, fundamental opinion about what you want to talk about, phone numbers here: 833-288-0973. That's 833-288-0973. Let's talk about the pay decline, because we said a few years ago that eventually workers would be coming back to the office and they would not have the same leverage for getting higher pay. Well, that time may be just around the corner. According to ZipRecruiter, the average pay for the majority of jobs has declined from last year, with some of the steepest declines being seen in technology, transportation, and other jobs that had big hiring back about 2 years ago.
Now, ZipRecruiter conducted a survey in July with about 2,000 employers, and the results revealed that nearly half of the employers said they had reduced the pay for recent job openings. I don't see this reversing. I think in the next year or two, we will see further declines in pay as competition for jobs comes back to a more normal level. Again, just kind of going back to what we were saying, just we need the economy to normalize from these wild swings to actually get back to a more consistent and understandable level.
And I do remember people saying, oh, you don't get it. People are never going to go back to the office. And we said, no, things will change. And the employers will get people back as the economy slows. And we are seeing that happening. They are saying now we'll come back to the office at least 3 days a week, maybe 4 days a week. So we're seeing that change back to it. And it doesn't happen in 1 day, 1 week, 1 month, even sometimes 1 year. It happens over time. And if we do, if the Federal Reserve does increase rates too much and does hurt the economy, and the economy goes down, you have unemployment go from 3.5, they're talking to 4.5, 4.6, you'll see that change even more because that does put the employers in charge saying, look, you need to get in the office because we need to be more productive.
Well, and one of the more ironic things is one of the companies that I saw asking people to come back, Zoom.
Oh, really? Yeah, that is amazing to me.
And it's not a full back in office thing. It's like a hybrid type model. And I didn't see how many of their employees are asking to come back. But it just, again, shows that not everybody can work from home. And if Zoom is asking people, and even if it's a smaller part of their workforce to come back to the office, it's like, yeah, not everybody can do this whole work from home thing.
Yeah, and it is ironic. Zoom. Work from home, but you need to come to the office for us.
I don't know if that's good for their PR. Yeah, no, we should do all these Zoom meetings. But you're asking people to come back to the office. Huh, interesting.
Little different there, but yeah, it is amazing. So this information comes from our newsletter that we write, many different topics, and some of the other topics we talked about in the newsletter that went out yesterday was ad-free streaming. We talked about home prices, streaming usage, the housing market, hot sauce price, and even we talked about NVIDIA a little bit, what's going on with their craziness, we'll call it. If you want that newsletter, it is free. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. It's right in the middle of the page. Sign up for it, free. Goes out on Friday at 5 o'clock. And you can see at that tab the past newsletters as well. So, all right, phone numbers here, 833-288-0973. That's 833-288-0973. Let's go out to San Diego and speak with Val. Val, you're in the Smart Invest Show, Brent Chase. How can we help you?
Recently took a dive on reduced guidance, and I'm wondering whether the dive is steep enough now to where it might be a good buy.
You know, and sometimes I'm kind of looking at it because retail has been beaten up a little bit. Macy's is I think one of the stronger retailers. We're going to look at the numbers here for you, but it's something that I think could be pretty good, except I do see that the short on the float is nearly 10%, which shows me that there's a lot of people think it's going to go down lower. They do about 83% in institutional ownership. By the way, the symbol on Macy's is M, as Macy's. We do see a very low PE ratio of 4.5 versus 19.8. Price to sales 0.1 versus 0.4. Price to tangible book value 1.1 versus 7.5. And price to cash flow also very good, 2.1 versus 6. Now, there's no PEG ratio, which is disappointing, but it's nothing for the industry or Macy's. We do see over the last year, earnings did decline by 26.2%, industry down 13.1%, so that's not good. Sales for Macy's were down 3.9%, when the industry is up 7.3%. And this is the industry of department stores, so they are competing pretty close to what they do, so disappointing news there. We do see that they have a nice dividend yield of 5.5% and only use 16.6% of their earnings to pay that out, so that's a very, very good positive there. Looking at the balance sheet, current ratio 1.2, same as the industry. Debt to equity 1.4, that's below the industry at 1.8, but at 1.4 I start to get a little bit worried that they could be getting too heavy in debt. Net profit margin checks in at 4.2, that's double the industry at 2.1. Return on equity very good, 25.1 versus 7.7, and return on invested capital 11.9 versus 7.9. Chase, what do you got?
Yeah, so current price here for Macy's, well, it's $12.08. Looking at the 52-week low, it's $11.86. So I'm guessing it hit that. Yep, hit that yesterday in trading news. And then the 52-week high is $25.12. So I mean, it's definitely been hit quite hard. I see year to date the stock's down about 40%. If we go forward, though, to January 2025, they do report on a fiscal calendar, a fiscal basis rather than a calendar year basis. I see estimated earnings per share of $2.84. I mean, it gives us a target sell price of $47.14. I mean, it's trading at a forward PE of under 4.5 times.
And actually, I'm looking at the earnings over the last 90 days for February 2025. They're actually down about 19%. So they are seeing worse things for this company going forward, but they're still projecting to make money. And I think they have a great online system as well. I think the question you asked Val was, is this the bottom? Tough to say.
No, I didn't ask that. I wondered whether it might be a good buy to look for in the near future.
Okay. I misunderstood that or misinterpreted that. But I almost say, based on the numbers, forward and past, Macy's right now is a good buy. Plus, you collect that 5.5% dividend. I just have a hard time thinking that something is going to change tomorrow. You might have to be patient with this. And I don't like the debt level. I guess you'd want to, when you're investing in this company, see what the debt is coming due, because they could have a big bond coming due in the near future at a higher interest rate that would really hurt their earnings going forward.
Yeah, I'm actually going to disagree, so you're going to have some thinking there, Val, on what you want to do. But, when I look at a company like Macy's, I mean, the value is there. The numbers look great. But my concern is it a great business? Mm-hmm. And, that is something you have to look at, saying, is Macy's going to potentially grow from here? And I feel like retail is so fickle. And the thing that worries me about a business like Macy's is how much of this direct-to-consumer business are a lot of these brands like Nike, like, the Michael Kors, the Coaches, the businesses that they're getting product from. How much more are they going to try and push in direct-to-consumer? It could really hurt Macy's going forward, and all of a sudden the earnings estimates could fall from 284 down to they start having cash flow problems, and then they turn into another Sears. The retail business it scares the heck out of me for businesses, the department stores.
And actually, I did see something from Nike saying that they are going to push more back towards the retailers because they saw better sales there. So I don't see retail going away. I got to say, I could be a little bit biased because it seems at least once or twice a week, I show a package for my wife showing up from Macy's, and she gets some great deals there, great clothes they have. It's a very good value. So
it's funny. So my wife hates Macy's, so that maybe that's the discrepancy here. I don't know.
Well, there's a difference of 20 some years, I guess.
But there's just thoughts that I would have there, Val, if I was looking at getting into retail. Is this a growing industry, or could this become a dying industry where the numbers look great, but the businesses go the route of the Polaroid camera, and even though the PE looks strong, but all of a sudden in 5 years, the earnings is just not there anymore.
Right, and I'm going to say I think it's a good buy as long as the debt issue is not going to get worse, I'll put it that way, and the cash flow is going to pay that debt. So, and
kind of just on the subject here, but I would want to understand more about the whole shrink issue, because theft has been a huge issue for these retailers. And I think it's not a long-term issue. This is something that should get resolved over time, hopefully through maybe politicians start actually having some more regulations around stealing and not allowing people to take stuff up to $1,000 cap, because this is just hurting retailers, and the retailers are going to find a way around it at some point. But in the meantime, it's crushing them. And I know it's hurt the Dick's Sporting Goods, it's hurt Macy's, it's hurt several other retailers. Target has talked about it. So, it could be, I'm going to say, a short-term fixable problem as well for retail that it could benefit growth down the road. So, there's a lot of different thoughts with Macy's that you have to consider, I'd say.
Yeah, it's just such a good buy at these levels. Some things to consider, but I like it, but I do have my reservations. So you gotta get through that, Val. All righty?
Well, I've never invested in retail before, and I don't think I will.
Well, Val, thanks for calling. You have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Let's go out to Tim in Mission Valley. Tim, you're on the Smart Invest Show, Brent Chase. How can we help you out?
Thanks so much. Good morning.
Good morning.
I was wondering if you could check out the company DHI, the home builders.
Yes.
Speaking of new, just thinking of buying, and want to know what you think.
Yeah, and I'm glad you brought this one up because we talked about this early in the show about home building and what's going to happen. So now we can actually look at a home builder to see what their numbers look like. Company again is DR Horton. Symbol is DHI. They're in the residential construction. Float, not very much, 3.5%. Institutional owned, about 88%. Good PE, 8.2, just slightly above the industry at 8. Price to sales, 1.2. Industry, 0.9. Price to book value, 1.8 versus 1. And price to cash flow, kind of expensive, 11.8 versus 8.5. We do see that the earnings last year are down. Well, it surprises me. They're down 9.5%. The industry is up 16.9%. So I'd want to find out, why did DR Horton earnings fall last year when the industry was up? Did they take some write-offs? What happened there? Their sales are up 8.3%. Not as good as the industry, up 12.6%. And we do see the analysts get a 5-year growth rate of a negative 5.6%. The industry only a negative 0.2%. So something's going on with DR Horton here that you got to really look into. They do pay a dividend, or is a dividend yield? 0.9%. Use 7% earnings to pay that out. Look at the balance sheet. Current ratio 12 versus 8.5. And I do believe, remembering builders, they have something different on their balance sheet that gives them a lot more liquidity. And I think they include the inventory in there or something strange on them. Do you remember?
I do remember it was strange that one of the home builders we held kind of did accounting a little bit different than some of the other home builders. So there was always a discrepancy between their numbers and the industry because of the way they carried inventory, I believe it was. So
I think because they sell the homes, they get to put the inventory in the current ratio, and they're obviously home is very expensive. So I think that's what it is. But you want to look a little bit closer at Tim to understand why it's 12. But the industry's at 8.5. And then we got debt to equity 0.3, same as the industry. Net profit margin 14.1 versus 10.9. Return on equity 22.5 versus 19.6. So looking pretty good. Chase, what do you got?
Yeah, so current price here for DR Horton, again, the ticker symbol is DHI. It's $114.94. 52-week low here, $66.01. And the 52-week high, $132.30. Now, if we go forward for DR Horton, again, we go out to September 2024. They report on a fiscal basis. Estimated earnings per share is $13.54. It gives us an attractive target sell price of $224.76. So it looks attractive from a valuation perspective. Trades at about forward multiple of 8.5 times. So that's appealing. Now, the concern I have with home builders is, as we kind of talked about earlier in the show, they're in like a perfect type environment right now. Is 2-3 years down the road, things start to slow down. All of a sudden, their growth slows, the margins start to compress. That multiple could expand quite quickly. And if you look at earnings for home builders, it's a very cyclical industry. So you have to be careful during the best times. Home builders are not going to hit a PE multiple of, let's say, 16, 17 times. It's just not going to happen, most likely. During the downturns, when earnings are tough, their PEs could skyrocket to 30, 40, 50 times because the earnings are so cyclical and so volatile. So I'd be very careful looking at this on just a PE type basis. And you've got to understand that things are pretty darn good for the home builders right now, and things could turn over the next few years.
And actually, I see in the earnings estimates from the analysts, they're up. Reverse of Macy's, they're up about 22% over the last 90 days. So they're seeing better and better things for them. I will say, too, when we had that home builder, they have changed things. They used to carry a lot of land and inventory, and that would really hurt them when things slowed down. They now do it a little bit differently. You'd want to check on DR Horton to see if they're doing the same thing, but to where they have options to buy that land. So they're less committed. On the other hand, too, that could hurt them because they might have to pay a higher price for it, or so better.
It should make the earnings more stable.
More stable is, I think, what they were trying to do.
You probably don't get as big of a peak because you're not getting the same margin on that land.
And the other thing too, not just the same margin, but if you don't want that land, you're just going to lose your option.
Yeah.
So it's going to cost you money. So I just think it's the time for a home builder has probably passed to buy them. I just don't see great things going forward. And we have seen huge increases in the price of home over the last, 4 years here. So nothing keeps going up like that. And I think I do see problems with the home builders at least in the next 12 to 24 months.
Yep.
All right?
Okay. Yeah, makes sense. Okay. Thanks so much.
All right, Tim. Thanks for calling. Have a good one.
Okay, take care.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Let's go out to Richard in San Diego. Richard, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hi, I was wondering about Ford stock. They're looking at a potential strike with the UAW, and it looks like they're demanding a big increase in wages. And it sounds like their EV sales or production is costing them a lot of money. And their quality control lately hasn't been so good.
Well, I think we say don't buy the stock. No.
I own it.
Oh, you own it? Okay, that was my next question. Do you own it? So, well, let's take a look at the numbers for you and kind of talk more about what you're talking about, because there are some headwinds coming up for all the automakers, such as a strike, which, Chase, you had some good comments before the show on the strike. But let's talk about Ford Motor Company. Their symbol is F. The industry's auto manufacturers. Float is only 4.3%, not too bad. So I'm kind of surprised on that number. Institutional ownership is a 56.2%. PE ratio for Ford, 11.6 versus industry not material. Price of sales, 0.3 versus 0.8. Price to book value, 1.1 versus 1.5. And price of cash flow checks in at 3.7, well below the industry at 13. Now, the PEG ratio, nothing for Ford. The industry is at 9.4. Earnings over last year are down 64.4%. The industry is up 3.9%. I didn't know Ford's earnings were down 64%. You'd want to find out what that was. That's surprising to me. Sales did rise by 14.7% for Ford, but not as good as the industry at 20.6%. The 5-year estimated growth rate from the analysts, a negative 1.8% for Ford, but a positive 8.1%. I think those numbers, as I'm talking about, are coming a lot maybe from Tesla, who is now in the auto manufacturing industry. Dividend yield, 5%. They use 58%. Their earnings to pay that dividend out. The balance sheet, current ratio 1.2 versus 1.5. Debt to equity is high, 3.3 versus 0.5 for the industry. Net profit margin, 2.4 versus 5.9. And return on equity, not as good as I'd like it to be, 9.5%. I usually like to see it somewhere around 15. Chase?
Yeah, so current price here for Ford, $11.91. 52-week low is $10.37, and the 52-week high is $15.42. And I guess we'll just kind of share the comments I had beforehand. Don't want people to be wondering what I was saying about the auto manufacturers.
Forget about it.
Yeah. I kind of talked about this on a previous show, but, the UAW, their demands are asking essentially to increase labor costs at like $80 billion for each of the auto manufacturers over the life of the next contract. So you break that down over a 4-year period, that's about $20 billion a year. Well, they're complaining that it's not fair that the auto manufacturers had a combined profit of, I believe it was like $21 billion last year.
Right.
So you're going to take it from $21 billion and you're going to make them pay $60 billion total each year. You're going to destroy these companies, and I still really believe this strike is going to be a short-term issue. I believe there's going to be a lot of volatility in these stocks because the UAW is going to come out and say, oh, that's not fair, and they're going to have these high demands. They're saying they're not going to cave. I don't think the auto manufacturers are going to cave because they know if they caved on those demands, they'd be out of business in 2-3 years. Now, what I look at as well on that is there's 11 weeks, I guess, of strike pay that the UAW has.
Yeah.
And that doesn't include health insurance or COBRA, which they'd have to be also paying for at that time. So that should actually increase the burn rate on that. So it should be less than 11 weeks of what they have available to their strikers or their union members. And I know that the auto manufacturers, they're going to have increased labor costs, but there's no way they can afford the demands that the UAW is going after. So I think you're going to hear a lot of negativity. The stocks are going to be volatile, but I think come, January of next year, we'll kind of be through the noise. You won't have to really worry about it, I think, for 4 years.
and people don't want to strike during the holidays. They want their job. They want to buy presents and so forth. So I think we could have a strike. but it could be resolved by late October, maybe early November. So.
And they're asking for close to a 50% pay increase essentially over the 4-year period. I'm just trying to think logically here, is if I'm a union member and the auto manufacturers say, oh, we'll give you a 25% pay increase, I'd do that, and then all of a sudden you start to create some rifts between union members and the UAW, and then hopefully there gets a deal that's resolved. But there's no way they're going to have all those demands come on through, because it would destroy the auto companies. And quite frankly, if they fell and they caved on these demands, I would sell these even if the stock went down 30-40%, because there's no way they can afford this over the next 4 years.
They'll not be profitable.
But I do want to give the numbers. Kind of went off on a side tangent there for Ford. I go out to December 2024. I see estimated earnings per share of $1.89. It does give us a very attractive target sell price of $31.37. So, the value's there for Ford. I think they do have some good products in their auto lineup. I think as long as we can get through the strike with a fair deal for everybody, I think this would be a good buy at this level.
Yeah, and I think you said you hold it. Is that correct, Richard?
Yes.
Yeah. And the other thing, too, that we didn't talk about was the political side. The president does not want, the unions to strike. He doesn't want to destroy the economy. So there's a lot of factors there, and the gut feeling is, I'm going to sell this before the strike. We had the same feeling in our auto manufacturer, but we said, no, we know it's going to be a bad short time period for our auto manufacturer, but we think we'll be better down the road. And as Chase said, though, if they do agree to that, which I don't think they will, that high thing, we probably would sell it at a loss there. But same thing for Ford. We saw good numbers, and I do see their earnings are up, 14% estimate over the last 9 days. So the analysts aren't seeing a bad thing with the strike either.
Yeah.
So, but, I would say hold. How much percent does it make up on your portfolio?
Maybe about 2%.
Yeah. You'll be fine. Just be prepared for a rocky road. I'll put it that way. All right.
Okay. Thank you.
All right, Richard. Have a good one. Bye-bye.
Bye-bye.
All right. That does open the phone line. 833-288-0973. That's 833-288-0973. But now it's time to talk to our financial planner, Harrison Johnson, talking about tax gain harvesting. Harrison, how you doing?
I'm doing well, guys. How's it going?
Good. So let's talk about tax gain harvesting here.
Yeah, so not to be confused with tax loss harvesting, which is selling a position at a loss so it can be deducted against other gains or other income. Tax gain harvesting is the opposite, where you intentionally sell a position at a gain so that you have to report it as income. Now, that seems backwards. Why would anyone intentionally want to realize extra income? Well, it depends on your tax situation. If you're in a lower tax bracket than you expect to be in the future, the tax on long-term capital gains could be less to realize those gains now. So, for example, if you're in the first or second tax bracket, the tax rate on long-term gains is 0%. So even if you have to sell and report that gain as income, the tax rate on that income is 0. For married couples, this is income less than around $120,000. For single filers, it's income less than $60,000. Also, when people are tax loss harvesting, they have to be careful of wash sales, which means if you sell a position at a loss and then rebuy it within 30 days, the loss is not allowed. This does not apply to tax gain harvesting, so you can sell at a gain and then immediately buy back the same position with no negative repercussions. So if you want to continue to hold that investment, you can sell it, buy it back, which steps up your cost basis, which will then reduce the amount of tax you have to pay in the future when you do decide to get rid of it. So usually people try to defer income, but in some cases it can make sense to accelerate that income if you can do it at a lower rate. Some things to keep in mind: tax gain harvesting may not be taxable, but it is still included in your adjusted gross income. And some things like health insurance premiums can be based on your AGI, adjusted gross income, which this could reduce those premiums even if it doesn't increase your taxes. Also, this can only be done in taxable accounts like trust accounts, TOD accounts, individual joint accounts, not retirement accounts. And then usually this is something that you want to do looking at the back half of the year when you have a better understanding of your overall income. And then lastly, I think this is something that is viewed as an alternative to Roth conversions. With a Roth conversion, you're accelerating income from a retirement account ideally at a lower tax rate than what it would be in the future. With tax gain harvesting, it's the same type of thing, just a different account and income source. And usually you only want to utilize one of these strategies in a given year. They're taxed differently, but both are included in AGI, and both the Roth conversions will push up those capital gains into the higher tax bracket that you were trying to avoid.
You know, and Harrison, this is when a financial planner really is very important, because I don't believe most people are going to be looking at their next year income. People usually look at the here and now, and that's why tax loss harvesting is, I don't want to say easy to do, but it's more on their mind. I don't think anyone that I can think of, and I've been doing this for 40 years, ever talked about tax gain harvesting, because you got to think ahead a year or two, and people just don't think that way. That's, again, why a good financial planner is so important.
Yeah, and I mean, at the end of the day, tax planning is trying to keep your taxable income as low as possible, as consistently as possible, looking forward into future years. It's not just about this year or last year. It's how can we bring everything down consistently low. So, you know, tax gain harvesting, again, you're realizing income, but it could be tax-free or taxed at a lower rate than it otherwise would be. So if your income is super low this year, tax gain harvesting can step up your basis at no cost, which is going to reduce your future taxes.
And I'm trying to think of like a good example of this for people as well, but I just going to oversimplify things. But it could be like somebody that maybe they retire, they're living maybe off like some cash that they had saved up, but they're going to start a pension in 2 years, and that's now going to push them into the 15% capital gains tax bracket. So it would make sense over the next 2-year period to reset the cost basis and do this tax gain harvesting for people over that 2-year period. And then once you now start taking on that pension, you have less capital gains that could impact your overall portfolio.
Yeah, exactly. So whether it's a pension starting, whether it's required minimum distribution starting, whether you're going to get a raise at your job that's going to push you into a higher tax bracket, whether you're going to be selling a property in future years that's going to increase your income. I mean, there's a whole range of things that could happen. But, again, you want to project out what your assets and your income sources are going to look like over time. And during the low spots, look at a Roth conversion, look at tax gain harvesting to kind of bring up those lower years so that your future higher years aren't pushed even higher.
And I did want to say, you forgot to mention one risk to this strategy is our lovely state of California. You still have to pay income tax on those gains. So
it's still going to be taxed on the state side, which that's always going to be the case. Yeah. But again, if you're in a lower tax bracket on the federal side, you're also going to be in a lower tax bracket on the state side. So there might be a little bit of tax to pay on the state side. California just treats it as ordinary income, which most states do that. But, overall, it'll still make sense. Because if you get pushed into the 3rd, 4th, 5th, 6th bracket federally, then you're going to be pushed into the 9.3% bracket on the state side in the future. So if you can, realize some gains now, and then on the state side, it might only be 2%, 4%, something like that. So still makes sense.
Great. Well, Harrison, thank you very much. We appreciate it. Have a great weekend, and we'll see you on Monday.
All right. Thanks, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson. He's a CFP. He's our financial planner. Remember, he's on a salary. He doesn't sell any products or annuities or life insurance. He is a true fee-based financial planner. If you'd like a free consultation with him, give him a call at the office at 858-546-4306. That's 858-546-4306. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. You can send him a email. Chase, I do see on our website, it does say free consultation. Does he pop up or just us a pop up for the free consultation?
No, if you contact us there, it actually goes to myself. So if you want to talk to Harrison, I get those emails, I can just pass that along to him.
So you can click on the free consultation and say you want a free appointment with Harrison for the financial plan, and we'll get that done for you. All right, phone numbers here, 833-288-0973. That's 833-288-0973. Let's go out to San Diego and speak with Tim.
Hey, guys.
Hey, how you doing?
Good morning. Good. You're going to get a free plug here for Harrison.
Oh, good.
If anybody's hearing, he's awesome. I'm 63, and I've gone through so many financial planners over my lifetime. He's the only one that stands up there and makes sense and teaches you and just doesn't say, give me your money and I'll plug it in somewhere. So anybody thinking about it, you gotta talk to Harrison. I keep telling all my friends.
Well, good, Tim. We appreciate that.
And just to confirm, that was not a paid advertisement.
No, that was not a paid advertisement. But I just had to say that because I've been he's great. Yeah, he gets me. So I was asking about. In fact, I mentioned this to you, Brent, the other couple weeks ago at a dinner about Berkshire B. Mm-hmm. And I wanted to get an analysis of that because they have a whole bunch of companies. They're almost like a mutual fund.
Exactly.
So I just wanted you guys to analyze that.
Yeah, and I always like to look at this once in a while, the Berkshire Hathaway, which is, I don't say run by Warren Buffett because now he has his lieutenants that actually I think make more decisions than he does, but he is why we use our philosophy that I read him like 30 years ago, like, wow, this makes a lot of sense. And I really looked into value investing. It's because of Warren Buffett. But it's always nice to look at the Berkshire Hathaway, portfolio here. They are in the industry of insurance diversified because he runs this as an insurance company and does the investments in the insurance company. Not much float on it, 0.7%. Institutional ownership is only 65%. PE ratio 9. That's below the industry at 9.7. Price to sales 1.9 versus 1.1. Price to book value 1.4, same as the industry. And price to cash flow 18.1 versus 12.5. They do have a PEG ratio of 0.9, nothing for the industry. Now, I looked at this. I'm very shocked on this. I don't know how they did this or why it is this way. It could have been low earnings the previous year, but the earnings show they increased by 706%, but the whole industry is up 727%. I don't know how that number is so strange because it's obviously very high. Sales are up 51.1%. Industry is up 47.6%. The 5-year growth rate for Berkshire Hathaway is 23.3. That's very attractive, especially when the industry is a negative 20.2. So they're getting some good numbers here for Berkshire Hathaway. They do not pay a dividend. Look at the balance sheet. There's no current ratio. Again, being an insurance company, a little bit different accounting. Debt to equity 0.2 versus 0.4. Net profit margin 21.6 versus 11.6. That's very positive. And return on equity 16.1 versus 16. Chase, what do you got?
I was going to make a couple comments about Berkshire Hathaway overall as well. And it's interesting because he buys or has the investment portfolio where he buys, individual stocks like, Apple's one of his largest holdings, but he also is, I'm going to say, a passive investor because when he bought like Geico, when he bought See's Candy, I forget which railroad, I think it's Burlington Southern, or he has a railroad in there as well. It's not like he's actually running those businesses. He just buys them, gets the cash flow, and the people still run the business for him, essentially. So it is a very diversified business. I want to say Geico is probably their big money winner. I would be curious what the breakdown is of how much those companies contribute to the bottom line for the Berkshire Hathaway. And the other thing that's interesting with the earnings on this company is I think they're going to be so volatile because his investment portfolio is so large that when you do the accounting on the earnings for the gains and losses on those positions, it can create kind of a lot of volatility within the earnings gains and losses in the total company. So the accounting behind it's going to be a little bit more complex. But looking at the current price for Berkshire Hathaway, it is $355.93. I see the 52-week low, wow, $259.85. And the high is $364.63. Now, there's only 2 analysts that cover this company. I don't know if it's just because it is such a complicated business when you actually have to dive down in each business that a lot of analysts just don't give earnings estimates. But of those 2 analysts, I got to December 2024. I see estimated earnings per share of $18.84. Fortunately, gives a target sell of $312.74. Trades at a forward PE of close to 19 times. So it's not an inexpensive stock.
Yeah, and what worries me about Berkshire Hathaway is that, as we kind of talked to him, it is kind of like a mutual fund. Warren Buffett is pulling back somewhat. He is, 90?
I was just looking up his
I
age.
think he's like 90, 91 now. I've seen changes on things they buy, which he never would have bought before. And he talked about, I remember him talking about, buying value companies and really getting the deep value. That doesn't seem to be the same management style of the new gentleman coming in. I forget their names.
Tom and Tim and Wexler and Combs.
Yep.
Like I forget which last name goes with which first name. But
they seem to have a different philosophy, and that's one thing when you do buy a mutual fund, it's who is managing that portfolio. I just feel it is changing, and I can't knock it. It's done very, very well over the years. And they also did. I mean, Warren Buffett would never do foreign stuff. They've done some major investments in Japan now. I've seen and stuff. So it's not the same Berkshire Hathaway from before. But I just, I can't recommend it because I just think it's going to change in the next 5-10 years. Be a different story.
And I still believe that company has one of the biggest CEO risks and one of the biggest CEO premiums because of Warren Buffett's name. And
don't forget Charlie Munger too.
Charlie Munger's. I'm hoping he makes it January. I think his birthday is January 1st. But born January 1st, 1924. So he's 99. Right. If he can make it to January 1st in the business, he'd be 100 years old being a part of Berkshire Hathaway. That'd be very, very impressive. And Warren Buffett is now 92.
Yeah. And they do have that large position in Apple, which does kind of worry me. Apple's a great company, but
Warren Buffett's birthday is actually in 4 days. He'll turn 93 on August 30th.
Let's send him a birthday card.
Yeah, I'm sure he gets plenty of those.
So Tim, I hope that helped out on Berkshire Hathaway. How we kind of look at it. And stuff.
Yeah, he was. Remember, he was anti-Apple for a long time.
Yeah.
And my concern is, yes, it's the CEO name. So if he passes. Charlie Munger is one thing, but if Warren Buffett, a lot of people don't know who Charlie is, but if he passes, I could see this thing coming down because people just freak out, even though he's not even making these selections probably in the last 10 years.
Yeah, you're right. Yeah, so
it's weird. One more thing before I go.
Sure.
I don't want to hog time, but if you can off to the side, maybe someday do Disney because it's at a 9-year low, and I'm just interested to see your thoughts on that.
Yeah, I mean, we get some quick thoughts because right now the whole entertainment industry is really getting beaten up because of the strike. It's over 100 days now. There's one company that they didn't want to release this film because the actors can't advertise it yet. So Disney, Warner Brothers, Paramount, I can't think of the other ones.
Comcast.
They're just having a very difficult time with this strike because it's now starting to hurt. They're now getting to the point where they don't have new stuff coming out. And once they come back, the writers and the actors, well, you don't have it immediately. You got that ramp up time. So Disney, I think, would be in the other category that it's pretty good. There's things on Disney that you got to remember. They do have the theme parks and the cruise ships and stuff. But it is. I think it was a 14-year low, I believe.
Yeah, we can maybe
not
add
14-year-old, but it hit a low in 2014.
Yeah, we can add it to a list, and actually, I know you won't be at the show next week, so I'll add it to my list, and I can cover that on next week's show and go through the numbers.
Yeah. All right, Tim?
All right, thanks, guys. And one more plug. Anybody wants to donate money to a good charity, it's Shelter to Soldiers, helping out dogs and helping out our veterans.
Well, we were there, so we appreciate that plug as well.
All right, thanks, guys.
Thanks, Tim.
Bye-bye. All righty, that opens up the phone line, 833-288-0973. That's 833-288-0973. While waiting for the calls to come in, let's look at NVIDIA. After NVIDIA's blowout earnings report, I was surprised to see the stock has now fallen over 2% since the numbers came out. Earnings per share of $2.70 beat the estimate of $2.09, and revenue of $13.51 billion easily topped the estimate of $13.22 billion.
Also here, we look at the guidance. It was very, very impressive as revenue in Q3 is expected to be around $16 billion. This would be an increase of 170% compared to last year. Now, the lack of gains following a big report like that may be concerning for current investors. I know probably for the first half of this, you're like, I thought you guys didn't like NVIDIA. It sounds like we're pro on it. But the reason I'm concerned about the lack of the reaction is the valuation concern may have kept other investors away and led to some taking profits after the big gains this year. The company still trades at over 40 times January 2024 estimated earnings, which tells me the stock is priced for near perfection. If the company hits any speed bumps, the stock could tumble quickly. And speed bumps I'm talking about here is, they're looking for 170% growth next quarter. If they come in at 150% growth, that would be a problem, and the stock would likely sell off. So you just got to be careful where there's not as much maybe excitement from people that aren't invested in NVIDIA, and the people that are invested in NVIDIA, well, maybe they'll start to look to take profits, which could put pressure on the stock as well.
Yeah, and it's one that, congratulations, somebody held it. And I got to say, NVIDIA's done a great job of pivoting from cryptocurrencies to gaming to AI. They seem to have a good crystal ball of what's going to happen going forward. So you got to give them a good pat on the back there. But gosh, there's just so many things that go wrong with this. Again, you come out with 150%, increase, like, oh, not good enough, and the stock would fall. And actually, the stock has fallen, as we said, from the highs here.
Yeah, and I do wonder as well is, it's great to kind of have that first mover advantage, which they do. But
first what?
Mover. So
Mover.
they're the leader in
Right.
AI chips. There's no doubt about that.
Right.
But the problem is they're still quite expensive, so it could take some time for these companies to adopt the AI chips, and it could give some of their competitors more time to catch up before AI is kind of more broadly accepted and really implemented in our day-to-day lives, I would say.
Mm-hmm.
So it could maybe hurt them that the chips are that expensive, and then what does high margins do? Creates competition because other competitors say, I want those margins.
Right.
And I could do that for a little bit less and still, instead of getting a 50% margin, I'll take a 40% margin.
Yep.
NVIDIA could come back and say, well, I'd take a 30%, and
Right.
it creates that competition, which helps prices, which could hurt NVIDIA's gains, I would say, over the next 5 years.
And also, I have read a lot about AI, and there are some legal problems with it that are still there. There's lawsuits out there fighting it, and it's just not always the best here. So it's a very hot topic. And actually, Microsoft, I believe, went out quite a bit because of that. They've pulled back, I believe, like 10-15% since the talk of AI for them.
Yeah, it's hype never really lasts.
Yeah.
It's, we've talked many times about different things like 3D printers that were going to be all the rage. We've talked about the cannabis stocks when, cannabis was going to get legal and it's going to be a huge thing. And, AI could go the same route. And, we've talked before as well about the .com boom is, your companies like Cisco. I mean, Cisco actually did great during the tech bust in terms of a business performance, but their stock fell 90% because they didn't do as great as people thought they could. Right.
And they still do pretty well. When I just saw they had good earnings and so forth on Cisco, but you just can't be on the top of the mountain forever.
Yeah.
And NVIDIA, great company, did great things, very impressive what they've done. Stock price, very impressive, but it's hard to keep hitting that home run every single time you come to the plate.
Yeah, it's definitely something to keep an eye on here.
Ask the Padres.
Yeah. I lost last night, but...
Yeah. That's why I said that.
Yeah.
Let's talk a little bit about streaming usage before we go here, because according to Nielsen data, linear viewing, which combines broadcast and cable, made up less than 50% of TV usage in the month of July for the first time ever.
This comes as streaming usage saw a 25.3% increase in time compared to last year and occupied 38.7% of TV usage in the month. It looks like cord cutting has really continued to accelerate and it will likely continue to pressure broadcast and cable.
And I got to admit, I cut my cord, and I really liked cable a lot because the way it was laid out and so forth. But I finally said I moved, I'm not going to get cable. I'm just going to stay with the streaming. I do think streaming is more confusing sometimes because, what do I watch? Do I watch Netflix? Do I watch Paramount? What am I going to watch here? And then did I watch that yet? Because with cable on the DVR, once you watched it, it was gone.
Yeah.
And it would save stuff for you. Well, now with the streaming, I kind of got to remember, did I watch that series? Because you get so involved in the series. I mean, it's confusing for me.
There's lots of options and,
too many options sometimes.
Too many options, yeah. And it is interesting just to kind of see the space evolve. And, I think it is a potential winner here, as I think, again, we talked about retail and having that direct-to-consumer channel and being able to kind of control your own destiny a little bit more. I think it could be a similar situation where the winners in streaming are really going to be winners and the losers are really going to be losers because you're not going to be able to get that subsidized, benefit of, I'll get a few dollars from the cable package, to produce bad content, essentially.
And content is going to be the major thing for streamers. You've got to have good content that people want and keep producing that content. So I think having studios is very important. What you're putting out is very important. So there's only going to be, I think, a few players left down the road on the streaming side, which generally happens. You get all these players coming in and only the strong survive.
Yep.
So, all right. Well, there's a closing bell for... Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit the website smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. You can sign up for an appointment with us there as well. Thanks for listening to Smart Investing Show. We'll be back next week right here on the Smart Investing Show.
So amusing to think that I did all that. And may I say,